And we're live with the Virtual Real Estate Investing Podcast. How you doing today, Frank?
Doing awesome, man. Weather is great in New York, so I'm very, very happy. I'm golfing tomorrow, so my week is looking very good. How are you doing?
Excellent. I'm good. I would try to go back and forth with some funny banter, but I'm so excited for our guests. I just want to jump right into it. All right. So as I think of who we are and what our mission is in real estate, I think about it like we're kind of coming at it from three angles, right? This hopefully doesn't take forever, but this is how I've conceptualized it. Is one of the hats we wear is like the blue collar hat, right? Like a good real estate investor has to be the construction worker, the plumber, the electrician. Like we got to make sure we're good on that front, right? And then another hat we wear is like the tech piece, right? Like the Zillows of the world, the iBuyers of the world. We got to make sure we know how to use tech to leverage tech to find these deals, right? And then we've also got this third hat that we're trying to explore, which is it's kind of like institutional funding, right? Like what happens on Wall Street, what happens in these funds. There's ripple effects throughout all of real estate. And we're not an expert in any of those things, but we're trying to kind of learn as much as we can from all those areas right now to be the best real estate investors we could be. And that's my intro for our guest, Mr. Bridger. How are we doing today, sir?
Oh, this is going to be fun. I'm excited to be here, fellas. It's going to be a good time.
Cool. So you are all things fund. We got funds. We got connected because I was watching your YouTube videos, which are top notch, man. Your production value is seriously good. Tell me about it.
Well, thanks. Yeah, we try to put out all things about funds, how to start a fund, how to get going, how to scale a fund, all that kind of stuff. We try to put out because no one else talks about it. It's like this secret world of finance, hedge funds, private equity, real estate funds that no one seems to understand or know, and it's too hard to get into. And by the nature of just my family, and I've been able to run a few funds, and we're just like, we gotta democratize this, let more people get into the fund game. So that's what we try to do.
So before someone even attempts to start a fund, like how do you know when it's the right time, right? So we're real estate investors. We acquire houses every single month, right? Like when do you know it's the time to start a fund? When should someone start thinking about that if they want to scale their business?
It's a great question, and it's going to be different for everybody. I would say sooner than you think. Now, that might sound like, oh, he's just trying to say everyone to do a fund, but most people I talk to should have started a fund 5 years ago, and they've flipped 300 houses. They've already done, 10 commercial buildings, whatever. They're very seasoned real estate people, but they believe, well, I'm not the best in the Western United States, so I don't need a fund. And it's like, no, you can be the 10th best in the Western United States and still have a fund, right? So in the long and the short of it, I would say the time to start a fund though, is when you have, I love the book called Nail It, Then Scale It. When you've nailed it, whatever your niche is, whether that's in single family real estate, commercial, multifamily, whatever it is, and you're ready to scale, a fund is the catalyst you bolt on to your business, and it just allows you to take off and scale. Now, when I say fund, I use that term really broadly. It could be syndications. It could be a formal, Reg D fund. It could be, there's a lot of different things that go into that. We can talk about that in the show, but when you're ready to scale, a fund really is just a catalyst to growing a model that you've already tested.
Okay. I'm gonna follow up with that with a question relevant to us. So we secure all of our houses right now with asset to asset funding, hard money loans, private money loans, right? We have a house. I need $100,000. I ask someone for it. They give it to us. They charge us interest every month. We sell the house, pay it off, right? That's what 99% of people do. And it's profitable. It does work, right? So like, if I'm doing 10 houses a month, why do I switch to a fund, right? If my cost of capital is 9%, 10%, 11%, like why do I switch to the fund if that's my current model?
Well, first off, that's an awesome model, right? It's great. I'll give you a quick example. A guy that I've worked with in our group last year, and this is a little bit different, but he would flip every year about 4 to 5 houses a year and did a good job of it. I mean, it's pretty good to flip 5 houses a year and he makes some money. He started a fund this year. He's flipping 72 homes. Again, scale, right? 10 houses a month. Now, if you have to have the deal flow and all that kind of stuff, and if your cost of capital is already secured and you can scale to 30 houses a month, then great, just do that. But most people hit this point of a ceiling where capital either isn't in great supply or it's getting more expensive, or the second piece that I see that is most common is the I don't even know what to call it, but the security of capital. I'll tell you a quick example. My family, by the way, we're all in funds. We all run different funds. So my dad, I'll just tell you quickly, my dad is the co-founder of a $25 billion family of real estate funds. And that's how I got introduced to this game. And he's an awesome dude, has a rags to riches story. It's amazing. I pitched him on my fund. He's never invested any fund deal, anything I've ever done, but wasn't a fantastic mentor for me. So I'll probably reference my dad a few times. My brother is also a securities attorney. And so he's helped launch dozens and dozens of funds, chief compliance officer to $800 million real estate funds. So I'm going to share a few stories from them. So my dad, when he was launching one of his first funds, they were doing hard money. They were doing a lot of loans, got a lot of debt coming in. And on one of their deals, last second, they're closing on a Friday. They had like a $2 million pool coming in to do whatever deal. One of their last investors the bonds didn't clear, whatever, couldn't get the check in. And they were short like 90 grand. And they lost this entire deal because they were short 90 grand. And what it did is it hurt their reputation. And they lost the deal, and they lost, I think, a lot of earnest money that was down. And they finally said, we can't do this anymore. This is, and the work, by the way, the 3 weeks before that, they're calling investors every day, get the money in, and an investor wants to renegotiate. Well, can I do a little bit less this time? They got every deal they were doing was this whole syndication, and finally said, we're moving to a fund. And they set up a fund. They got all the money in on limited partners on a PPM, and they want to close on Friday for $2 million. Great. They stroke a check, bam, they close. And now they can transact. And what happens, their reputation starts to grow as someone in the area who can transact and is a for sure, yep, they're going to transact on that date. And so they started to get deals 5-10% lower than a higher bid because their reputation of transacting was so strong. So that's one quick example, I would say, of number one, so scaling beyond your current capital means, and number two, being able to transact. But if you've been already able to cover those and you've got a good model, you don't need a full out fund at that point. But for most people, they hit a ceiling where they need to scale beyond that.
Yeah, I think we're looking at our trajectory, like the trajectory we're currently on works, right? But we see a lot of opportunity in front of us that would be really exciting to try to take advantage of. One of the specific questions I'm excited to ask you is, in real estate, we see the syndication model for a specific property quite often, right? Like we can see lots of people going after a specific apartment complex. They raise money, they close. It's all about that deal. When they sell that deal, it's done. It's harder, at least for me, to find good case studies with single family homes where there's some type of those assets are coming in and going out, and that fund is either opening and closing, or it quickly gets overwhelming. But I haven't seen a lot of case studies for that. What are your thoughts?
And you mean a case study for a fund that does single families, correct?
Yes.
Yeah, I think it's just more common to do bigger properties out of a fund because it's just, you have economics of scale. Anybody and their mom and grandma can get $200,000 together and flip a house. Very few people can get together $38 million to flip an apartment complex. And so when you scale out of your competition as well. You guys both know it's so competitive, especially right now, to find inventory below $2 million, right? But once you start doing bigger stuff, so that's why I think your case studies are more and bigger, because most funds are like, well, we have the money anyways. We might as well do bigger deals with bigger returns and less competition. But like I said before, we have a guy I work with directly. He's doing single family homes, 72 homes this year. He's flipping currently. He's got 4 teams that drive around to different properties and do it. I think though, you just don't see as many case studies because of the competition. Now you will see case studies in development, right? And building and stuff like that. But as far as like a fund that flips single family houses, you're getting beat out on bids so often. You're like, well, we might as well just bid on an $8 million, an 8-plex or 10-plex, 12-plex, whatever it is, or commercial building because of that. That's typically what I see. But anyways, that's from my opinion, but I don't know. Maybe there's another thought.
No, I think you're spot on, right? I think you're spot on. And I think at some point we will be buying $8 million apartment complexes, right? But I think our comfort zone right now is not there. But we do think we could take $8 million and put it in single family homes and really, return a lot of.
But my question is this, and I'm going to fire back because you guys want to get a spicy podcast going here. But John, why is your comfort level not there yet? What's holding you back, and what's going to get you to a comfort level where you can do an $8 million apartment complex?
basically, I think the cap rates are so compressed right now that if there's any type of downturn in the economy, I think it's going to be really hard to exit some of those multifamily properties at that purchase price, right? So I think there's a lot of people that if the economy continues going like it is right now, they're going to look like heroes, right? Everyone who's invested in multifamily for the last 10 years looks like a hero. But some people are going to be left with their pants down. And whether it's a year from now, 5 years from now, 10 years from now, there's some macro conditions that I'm not super comfortable with. But where we buy single family and small apartment complexes is at such a discount that I know for sure on the back end or without certainty that we're going to be able to exit and not lose our ass.
Gotcha. So you're getting great discounts on single family right now.
Yeah, great discounts.
But if you found a great discount on an $8 million project,
good to go. Yeah, good to go.
Gotcha. Okay.
It's a chicken or the
I hope
egg.
you guys are okay with me asking you questions back. I think it's kind of fun. I
love
don't know. Let's go back and forth. I don't know. Let's give it a shot. We're here.
I think we're full of shit. Just tell us, right? So that was good. So, but
I love it.
The chicken or the egg thing, right? Because you made a point before that resonated with me, and I'm going to restate it. You kind of said in a way that having the cash ready makes you a better negotiator, right? Like you mentioned that they get the 5 to 10% discount. And I agree with that a lot. I think when you have buying power, you tend to have a little bit of confidence when you're dealing with sellers or whomever it is, agents, and you tend to, I think, get better deals or better prices. So like Plum, we're kind of saying, well, the deals aren't as good. And Bridger's kind of saying, well, start the fund, you'll make it happen. Let's get down to the sequence of events. Let's say we are going to we're like, hey, Q3, $8 million or more apartment complex. We're going to start sending out direct mail, reaching out to agents. Like the marketing arm is ready. Like what is like the sequence of events? I send out the marketing. Like now what do I do? Right.
And you want to transition to a fund model or still do a syndication on that? Which route or
let's
both?
Do syndication. You cover both, I think. So let's just do syndication first. And then we could talk about the big fund after.
Well, it's very similar to what you're doing with single family or your first single family, right? I'm guessing, I don't know your guys' story, but I'm guessing your first single family home, it was like, oh, it's a little bit more than we have. And we got to find some money from people and put it together. And then now you get to a point where you can probably use your own cash and buy single families and whatever, but it's the same. It's all relative, right? So what you've done in the past and what you're planning to do in the future. And so an $8 million deal or a $60 million deal, step one, and we kind of teach this thing called the fund launch formula is number one, find that incredible deal. You guys know that, right? If you have a great deal lined up and you've got it, whether under contract, whatever the strategy is, it's so much easier to raise capital from investors. And we see this a lot. Like right now, I'm launching a new fund right now. We're doing big box stores. We've raised real estate funds. So we're on a real estate podcast. We've raised 18 million so far. We're raising 50 million for this fund. And it's funny, the pitch difference. And I wear this shirt called Wall Street Rebels, right? The classic Wall Street bro, their fund, they'll go and they'll pitch to an investor. Hey, we theorize over the next 18 months that we are so smart and we're going to go buy these great properties and we're going to be great. And we're from Harvard and we're very nice and smart. That's a good pitch, right? It's like, okay, great. Sounds like a good plan, good thesis. Awesome. We go to that same investor and say, hey, we're not from Harvard, but we've got this incredible building. It's appraised at $14.5 million. We can buy it for $7 million. We're closing at the end of the month. Look at all these great things we're going to do. June 30th or July 30th is our close date. Are you in or out? And you're smart. Have your real estate buddy or yourself. You guys can look at the deal, poke holes in it, whatever you want to do. And 9 times out of 10, I feel like at least we beat out the Harvard and Harvard fund because we have a tangible property ready to go and there's a due date. No, nothing happens without a due date, right? And so we tell them, hey, there's a due date and we're getting money in. And so I think it's probably a similar story to most people that did their first single family flip, right? Of you're talking to everybody, every investor you can get to put money in on a syndication. The same thing's true with an $8 million property. Just the numbers, the zeros are just a little bit more, right? It's a very similar process on a syndication, getting money in, closing there. But the returns potential are much higher for you as the person running the deal, which is again, why I'm such a vocal person about the scale piece of either large syndications or funds. It just adds so much scalability to that. But back to your question, step one, be finding that great deal. 2, what we do is we frame it out. So step 1, find the great deal. 2, by frame it out, I mean, run all your Excel numbers, all that great stuff, and put a pitch deck together. This is true for funds as well. We put a pitch deck together very early, and then I go talk to investors as soon as I can. And what I'll do, and I go pitch an investor at the early stages, I'll say, hey, we've got this great property coming down the pipeline. Can I show you some, if you're interested in doing real estate, I think this one's going to be awesome. And we, this is nothing set in stone yet, but let me run through it to a mentor or whatever. Let me run through some points here. And we practice our pitch on some mentors, see if they're interested. We refine our pitch. We go back. Well, how would we tweak the deal? Do we want to do an 80-20 split? Do we want to do, you guys get a pref or carried interest or a management fee, whatever. We practice that with our mentors, then we refine it a few times and then you can go. And there's a ton of money raising strategies that we can walk through as well, to how to get in front of those investors, how to convert somebody from a friend you meet at a party to a full out investor. But anyways, long and short of it, that's a long answer and kind of went over a lot of different ways. So there you go.
I'll try to follow up with another question. So one, like, what is the minimum amount for an $18 million fund that you'll take, right? You can't take $10, obviously. And like, who is the typical investor for you? You mentioned buddies, you mentioned maybe institutional players. Like, what does your investor look like?
It's a good question. So background on me a little bit. This is my third fund. We've ran 2 funds prior that were debt funds. We were lending on those on different entrepreneurship projects and whatever. And we did really well. I just sold it to a competitor just 2 months ago. Mm-hmm. Now we're transitioning to a real estate fund. So this is my first real estate fund. I personally don't know a lot about real estate. I don't profess to be a real estate expert at all, but I'm pretty good at funds. And so I found really great real estate partners that we brought together. And so on the fund side of things, again, we're raising 50 million. We can lever that into buying about 100 million or maybe 120 million, depending on how much leverage we want to apply to our properties. Maybe a little bit less, maybe 80, 90 million, whatever my real estate partners can decide that. So for our fund, we filed as a Reg D 506C fund, 3C5, if anybody knows funds, we file under. So those are all the SEC exemptions that we follow. Mm-hmm. And the great thing about funds is you get to write the Bible. And the Bible in typical funds there's 2 main documents. They're called the LPA, Limited Partnership Agreement, and your PPM, Private Placement Memorandum. You guys have probably heard of those. Mm-hmm. These 2 documents, they're thick. They're about 100 pages each. And we call them the Bible. Those are all of the rules, laws, covenants, everything that you're going to do in your fund. And the best part is you get to write the Bible. Yes, there's a few things you got to follow at the SEC, but a lot of the stuff is up to us to decide. So in ours, we wrote down, you have to have $100,000 minimum commitment to invest in our fund. And then there's always a little subline, unless the general partner, us, deem otherwise. We can have an exception, right? In our fund, we're going to charge a certain management fee. We're going to charge a certain pref or a catch up. And we have that all written down, all the scenarios on there. So our fund, and then from my past 2 funds, and you're back to your question of who do you raise money from? We're talking to everybody we can right now. Now, we can only raise money from accredited investors or above. We actually primarily want to go after qualified clients, which are a tier above that. And then there's one tier above that called a qualified purchaser, $5 million in assets. Qualified client is a $2.1 million net worth, excluding your home. And accredited investor is $1 million net worth, excluding your home, $200,000 a year or $300,000 a year with a spouse. So we're going after accredited investors or qualified clients, talking to everybody we know, right? And I've built a little bit of a track record for my first 2 funds that we've, rolled some of those investors in this fund because they had a great, investing experience with me. But we go a lot of routes to find these people, but primarily for this fund, we're not getting institutions, and institutions are not going to invest in this fund. Yeah. It's just too small of a fund. They're not getting. So we're going after family offices, high net worth individuals, is our 2 main categories. And there's a lot of different ways that we get in front of them, but I do a lot of the funds. I have a great real estate partner. We brought on another partner. And for people that might say, well, I can never do a fund because I can't raise the money, or I don't know how to do the real estate, or I don't know how to do whatever. No one does this alone, because no one does a fund alone. And it's not the how, it's the who. It's not how do I find money, it's who do I find to find money. So I brought in a great partner. He's on the board of Intel. His name is Dan Young. He's run all these great tech companies, Inc. 500 companies. He's got a gazillion tech friends with oodles of money. And so he's our main money raiser guy. I help do the structure, all the compliance, legal, all that stuff. We have another partner that does all the real estate, and it is a pretty nice hybrid. And yes, all of us help raise money, and all of us help kind of source deals, but those are kind of our primary roles there.
So as you think about your skill set, then, like, what does the next 20 years look like for Bridger? And the reason I ask that is, if your previous funds weren't real estate focused. This is real estate focused. Why real estate? And then, what's kind of the long-term play?
Yeah, it's a good question. So my first two funds were awesome. We were doing these small short-term loans and they were great. We got our really good returns to our investors. I think the last year we got a 46% return to our investors. Did really good, but they were small. We were dominating the market and we were doing loans for $2,000 to $5,000 to people doing debt consolidation. So it's just a lot of turn, a lot of deals and a lot of work for, a decent amount of money, but nothing crazy, right? Nothing life-changing. So I said, I want to pivot into something bigger. And so, but I got my ropes under me. I'm in my mid-20s. So I was great. We ran some funds. We had some experience there. Let's transition to real estate. So for the next 20 years, this fund one for us is, we're going to make some okay money, hopefully we make a few $1 million off of this, whatever. But hopefully, we're going to be launching fund 2 in about 18 months to 2 years. And then we'll launch a fund 3 about 2 years after that. And so then by fund 3, hopefully we're managing over, $500 million or $1 billion. And that's the trajectory that we're trying to go on and run right now.
Nice. And then when you pitch investors, how do you communicate your competitive advantage? And what do you believe your competitive advantage is in this space?
For our current real estate fund?
Yeah.
So first off is our team we've built. I've got an incredible partner, 2 partners, and then myself. So they come to me because I've ran funds before, right? I have a great track record of running funds and managing money very, very well. My other partner's flipped 300 houses. He's developing 2,000 units right now in Utah. He's got so he's got a great real estate record. My other partner's been on the board of Intel. So it's a good team, number one. Our value add proposition though, is there's all these big box stores around the country. And I don't want to give away all of our secrets that you guys are going to steal them or whatever, but we can, because of our network, first off, we get a lot of off-market deals and we can buy these stores for relatively cheap. We try to find very ugly, beat up, very distressed properties. And we renovate them up. We'll rezone them. We'll put in light industrial, put in warehouses in the back. We'll put in drive-throughs in the front. Small retail on the front. We only take publicly traded companies. And my other partner has a lot of great relationships with huge publicly traded companies that own a lot of franchises and restaurants. And so we're only going to go with big backed tenants. So a very strong tenant pool. And then also we've got a lot of friends, I guess you say, or companies moving from California to the Midwest right now. And so we already have a huge tenant supply of these people that they want to come to Utah. They want to live here. They don't want to pay some crazy square foot price to have an office. They're fine living in a crappy box. We make the inside look incredible, like Google-esque and just really great quality. And the outside, it looks ugly, but they come inside and just feels amazing. We've already done one of these properties in Utah. We bought it in 2018 and today we haven't sold it yet. If we sold it today at a 7.5 cap rate, we would have 3x'd our money on the property. We haven't sold it yet though. We have a potential offer right now for better than that. And so anyways, we'll see if we take it. We still have some work to do on it though. That we have a decent case study. And again, back to your point though, everyone's a genius in an up market, right? So we're trying to strategically plan our portfolio. We have other things we're adding into our portfolio, not just those big box stores, to have a competitive advantage if we do have a fallout in the real estate markets that, we believe our thesis will hold strong. So I don't want to, maybe my partners are going to get mad at me if I talk further about that, but that's kind of the overall thesis.
I like it.
I like it, man. I think you're being generous selling at a 7.5 cap. I think you could probably make more money.
Well, that's what we're saying. If just on our pro forma, if we sold at a 7.5 cap, that's what we'd get. So anyways, we hopefully are getting a 5.4 cap. We'll see what happens. So
unless it's class D, it's like, that's just the way things are nowadays.
Yeah.
Wow. Awesome, man. Congrats. I was going to ask, the one thing with starting a fund and investor behavior to me over the past 2 years is interesting, right? I think you had 2021 and 2020, an environment where everyone fled to growth, or flocked to growth, I should say. Value was like not the mantra. Everyone's like chasing it, the meme stocks, the Teslas, like all that other stuff. When you show pro formas to someone and you're like, hey, I'm going to stabilize this at a 7 cap or an 8 cap, if you're not really being aggressive on your appreciation, right? Maybe the IRR is only like 17%. Or 16%. And investors nowadays are like 17%. Screw that. I can make 40, Have you seen any of that like over the past couple of years since the returns?
Oh, 100%.
Kind of crazy?
I have a buddy, actually, really great guy. He runs an awesome fund. I don't know how much they have. I think it's $15 to $20 million doing hard money loans. And he's like, the last 6 weeks, this is during Dogecoin run and the crypto, whatever. And he's like, we couldn't raise money. All of our investors were like, screw you guys. I'm not putting money into you for a 19% return a year, And then he called me the day after Doge had a huge crash. I can't remember. It was like after Elon went on SNL and the crypto crash, whatever. And he's like, 3 of my investors have called me back and they want to put money in now. And so I thought it was pretty funny. But he had a hard time raising money until things crashed. So I think if you're dealing with a lot of those, I think you get more of that when you're dealing with new money and people that, they just made their first million or they just whatever, and they're all excited and they want to, invest in whatever. But when you start talking to family offices, to, people that have been in the game for a while, that have a net worth over, I don't know, 10, 15, 20 million, they understand the game. They understand the cycles. They understand everything. Yes, they're going to allocate 5 to 8% of their money into maybe some really high risk stuff, but the primary bulk of their money they want in assets that are going to make a lot of money. And right now we've had, I keep hearing different numbers, anywhere between 20 and 40% of our money supply has been printed in the last 12 months. Right. And I don't know the number because the Fed doesn't report it very well. Anyways, who knows, right? Who actually knows how much it is? It's insane. And so we all know inflation's coming, and people are just frantically trying to put money places, and real estate's always a great pitch. It's just like, look at the track record of real estate. I mean, it's just like, this is a great pitch. And on top of just owning real estate, we're going to do value add on this real estate as well. And we're finding an area of the market, retail spaces is kind of a primary part of our portfolio that people are trying to dump and get rid of because of COVID. Well, great. We'll pick them up and we'll repurpose them, or we'll build different things. So anyways, we're on different properties. So that's the way we go. And a seasoned investor understands that, and they go, yeah, you know what? That makes sense. And we even tell them, you should put in 10% of your net worth into just whatever you want to do. Right. But most people, 25 to 35% of their portfolios in real estate, if not more. And we want to offer you that part of your portfolio. So that's kind of how we go about it. And then you see these people know the volatility, and it helps out. But I thought it was pretty funny about the Dogecoin ones. Yeah. Anyways, have you guys seen the same thing?
Yes. I remember when we were raising money for our first, we made a push in last July. We're going to raise a couple $1 million to purchase houses this year. Right. And people would say, well, you're offering me a 10 to 12% return, on a 3 to 6 month deal. They're like, dude, I'm making 25, 30, 40, 50%. People want to charge you 17% for a hard money loan in a house. And obviously no one's going to pay that. So I would say 1 out of every 2 conversations I would have, someone would be disappointed with the interest rate I was offering them. Even though it's asset backed and the risk is generally low, they want the risk, right? So.
It's the risk adjusted rate of return. You got to almost explain that to them. This is what investing is, and this is what asymmetrical risk looks like. And we think we found it. And yeah, you can go to Vegas and put it all on red, but what's your risk adjusted rate of return? So anyways, that's interesting though.
Yeah. YOLO.
Sure. Well, Bridger, you told us what you're doing now, but tell us how you got started. And what I really want you to answer is, somehow I think you've made funds in syndications cool, right? You got a certain swagger about you, and you've made this stuff cool, which I think is an amazing feat, man.
Well, thanks. I don't know if it's cool or not, but we're trying our best to just put it out there. So I'll tell you the brief story of just kind of how we got into this. And I mentioned it earlier. I have a dad who runs a $10 billion fund. My brother, I'm just bored. And I understand the uniqueness of the position I'm in, and I get that. And that's why we create a lot of content, because it's unique. Most people do not have that. And so, but back to my story, actually, though, I grew up in a very entrepreneurial household. My dad drove a car with 300,000 miles on it. It was not like this crazy thing. And to put perspective of what they're doing now, Cardone Capital is what, 2.2 billion under management. Same asset class, they're 25 billion. That's how big they are, right? They're 10 times bigger than Cardone Capital. And today, but it wasn't always that way. And so anyways, I just grew up in this, I would say, an average, great household. I had great 2 parents and brothers, and it was awesome. But I went to college. I was super ambitious. I wanted to make a lot of money. And I knew I wasn't getting money from my parents. And so I was like, okay, I've got to start working. So I started 6 businesses my first 2 years of college. I did real estate wholesaling for my real estate people. I did 2 deals. I made $5,000 each. It was awesome. I built websites for people. I did Chinese tutoring. I mean, I did like anything on YouTube that talked about making money. Like I tried it, and actually we did okay. And finally, finally my dad grabs me and he goes, Bridger, I want you to go meet with my business partner. I think this guy can help you out. I'm like, okay, I'll meet with somebody. So I go meet with this gentleman. He lives in this gorgeous mansion. Got the pool in the backyard, the cars, the whole thing. And we sit down, we start to chat. And I finally just say, like, how did you get all of this? Like, how did you do this? And he goes, well, we started a fund. And, we started a real estate fund, me and your dad, and blah, 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 and all this great stuff. And I was really intrigued. The secrets of the wealthy he talked to me about, and all these wealthy families run funds, and the Forbes 100 list is riddled with funds. And so I was really intrigued. And I've always heard find mentorship, find coaching. So I said, hey, can you be my mentor? I'd love to learn from you. Be great. And he goes, Bridger, go talk to your dad. Your dad knows way more about us than I do. I was like, no. My dad's kind of poor. Like, you're obviously very rich and wealthy. I would love to learn from you. And he goes, Bridger, me and your dad make about the same amount of money. And my chin about dropped to the floor. I was like, huh? I was like, come again? And he's like, yeah, we started these funds, and yeah, we kind of make the same amount of money. So anyways, I drove to my dad's house. I was like, Dad, what the heck? Like, what's going on? Like, are you making all this money? Like, why don't we have a nice house? Like, what's going on? Anyways, long story short, yes, he's running these funds. He lives a very conservative millionaire next door lifestyle, which I really respect him for. And long story short, he started to teach me about funds, how they work, how they're structured, how they're put together. And over the next year, taught me everything he knew about funds. And I was working at another company at the time, doing an internship kind of thing there. And I had an idea that we could lend money to people that were the clients that were coming through this business. And so I talked to the owners of the business. They loved the idea. I talked to my dad. He loved the idea. We put together a fund. And I mentioned this earlier, but I was like, okay, I got the fund ready to go. Now I've got to raise money. And I thought, well, I'm going to go talk to my dad. Apparently my dad's rich. He doesn't spend his money. He would love to invest in my stuff. And so I went, and I remember it was a late Sunday night. I went and walked in his office. I knocked on his door and I said, Dad, how would you like to be our first investor into our fund? And he kind of laughed and smiled. And he said, he said, I have the money to invest, but if I invest in your fund, I would ruin the experience of you raising capital on your own. Your first investor is your hardest investor to find. And if I give you money now, to be a crutch that you'll never be able to recover from. And he said, no. And he kicked me out and he said, do this on your own. And so I took him up on the offer. And I went out, and I was 22 years old at the time. I'm in college, and I went and raised a whopping $49,000 for our first little syndicate fund. Just a teeny little amount from it was like 6 or 7 investors they're like, yeah, I'll give you $5,000. Like, it was just small, right? But I was ecstatic. It was enough to get started. We launched that first fund. We're doing these small micro loans, $2,000 to $5,000. Our first group of investors got a 64% return on their money. And it was just awesome. And then we launched our second fund. That fund we raised and deployed millions of dollars out of, like I mentioned earlier. And then we just sold that fund about 2 months ago. And now we're transitioning into a third real estate fund now. So I'm in the game. I'm in the process right now. And to this date, my dad has never invested in any deal, projects, anything I pitch him all the time for money. And he's a hard one to crack, but he's a great mentor. And he's always there to help and give advice and help out. But, and I really respect him for that. So that's kind of how I got into it. And then we started to teach people online how to do this. So I got my dad, I got my brother and myself. And we said, hey, let's start making some videos and put out courses and programs and coach whatever people want. Cause we just had so many people asking us, how did you guys do this? None of you went to Wall Street. None of you guys did the Harvard route. It's very unconventional. So anyways, we started to put out a lot of content and stuff like that. And anyways, that's where we started Investment Fund Secrets. It's kind of our whole, that side of the business. It's been really fun to do that. So that's why, anyways, that's the long and the short of it.
Yeah. So how nervous were you on your first pitch call when you were 22 years old?
It was, yeah. Oh, I was definitely nervous, but the thing, I was so confident though in the deal. And I think, a lot of people that try to raise money, they aren't confident in, they're kind of confident, right? You wouldn't want to give me some money, would you? Kind of a pitch. And I was so sold on the idea. And yeah, there's always risk, but I was like, man, I feel like we've got really asymmetrical risk here, relatively low risk with a potential of a high return. And I was so sold. I'm like, I'm putting my own money in this. Let's all put some money together. And so I think that helped me overcome the nerves. Actually, my dad gave me an example, if you're okay, if I elaborate for a second. When when I was first going out to raise money, and I was, Dad, I'm 22 years old. I'm not a college grad. I've never done this before. How do I raise money? And he gave me this example, and it changed my life, actually. He says, Bridger, imagine we just found a Lamborghini Aventador in Billings, Montana. There's a lady selling the car. It's going to auction. She's going into bankruptcy. She's selling the car for $50,000 Saturday morning at noon. And the car is perfect. We've had a mechanic look at it. It's a legit car. It's not like it's fake or broken or something. It's a legit car. We have a buyer in California that'll buy the car for $200,000 Monday morning, right? Classic arbitrage situation or a wholesale situation. You guys already talked about this. He says, Bridger, it's 100% guarantee. There's no way it falls through. Could you find $50,000 by Saturday morning? It's 100%. Just go with me as an example. And I sat down, I started to think about it. And I thought, well, 50 grand, we're going to make 150 grand spread, 50 grand by Saturday. And I thought former bosses, a college professor, a family friend, and a long lost aunt, right? And I thought, you know what? Yeah, I'm going to stay up all night, every night. But you know what? I'm like, I think I could find 50 grand. And he goes, why? I'm like, well, it was foolproof. He goes, what about 100 grand? Let's say the car is $100,000 and you're going to flip it to $200,000. Could you find the money? And I was like, yeah, you know what? Like, I'm going to make 100, maybe less to pay my investor. I'm going to make 60, 50 grand this weekend in college. Dang straight, I'm finding the money. I'm going to figure it out. I'm going to call whoever I need. I'm going to figure this thing out. And he goes, why? And I go, well, because it's foolproof. It's 100%. And he goes, aha, there it is. I'm like, what do you mean? He goes, if you go pitch an investor like that, guess what just happened? All the fears of, I don't have the track record, I don't have the college degree, all that stuff, guess what? It didn't matter anymore because you found a good enough opportunity to bring to an investor. And if you could raise $100,000 by Saturday, imagine what you could do over 6 months of raising money. And that example has stuck with me forever. And my dad, he'll keep telling me, he's like, I had a guy come pitch me in my office and he did not believe in his deal. He did not believe in it, like the Lamborghini example. And I think that's the problem that most people run into is they don't find a good enough opportunity that they believe in enough. So that's the mentality I went out with. And I raised 49 grand on that first one. It was actually more than enough than we needed because we're doing these small loans. And anyways, we've gone from there. So it's been good.
Yeah. I love that example because like that is the advantage you have over the Harvard guy or gal, right? Like your closeness to the deal, right? And your hustle. Like, I think that's hustle. Like It's hard to get someone with a high pedigree working at a large institution to hustle like that. Right. So I think that's a really, really awesome example.
The other thing I'll add to that too, because people might be being like, well, whatever, you're still young, you don't have experience, whatever. I literally in that pitch room, I would, I got my deck or whatever, I'm pitching my thing and I would stop mid pitch. And I still do this actually today because I'm almost 26 years old next week. I'm still fairly young. And I stop people mid-pitch. I go, all right, we got to stop. I know that you think I'm way too young to be presenting this deal to you right now. And 9 times out of 10, they kind of nod their head like, yep. Yeah. And I'm like, let's talk about it for a second. Okay. And this is on my first fund, right? I'm in college, whatever. I go, let's paint a picture, right? You want someone who's 55 years old with some gray hair that's presenting a deal that's been in finance for 30 years, right? That's kind of the person you want to come pitch you. And they're like, yeah, I guess so. And I go, Matt, if I'm 55 years old right now, a few things have happened, right? Number one, I haven't made a lot of money yet, apparently, because I'm still pitching this deal. So I'm still in the working around, okay? Number two, I've got a lot of habits. I'm not going to work weekends. I don't want to work late because I watch Netflix. I got soccer games to go to. I don't do that. I'm not going to stay up late and work hard. And number three is I have a higher degree to commit fraud because I have a lifestyle to maintain. I live in a nice house. I drive a nice car. I got a lifestyle. I might, embezzle a little bit of money. I'm like, guys, I'm 22 years old. I live in a $300 apartment. My car's paid off. It's only worth like $1,000. I have no reason to commit fraud. I have nothing else to do. I literally stay up all day, all night, every weekend doing this. And to top it off, I'm not charging any management fees. I don't make $1 unless you make at least 8% first. That was my pitch. And if I'm 55 years old, guess what? I'm taking a management fee. I'm taking acquisition fees. I'm nickel and diming you for every dollar you have. I'm young. My goal of this entire fund is that you have a great experience with me. And guess what? You're going to brag to all your friends about the great investment you had with Bridger. That's my goal. And that's the angle I went out. I leaned into being too young, and it worked on every time I brought that up to an investor, they wrote a check for me. And so that doesn't work all the time and for everybody. And I just had, by the nature of the position I was in, that's what I had to say and do. And I just leaned into it, went after it. But that helped me a lot to get over the hump of being too young, inexperienced, all that kind of stuff.
Very nice. So you mentioned him a few minutes ago, but since you wanted to maybe argue a little bit on the podcast, Grant Cardone, are you a fan? Is he a scam artist? How do you make sure you potentially end up like him or don't end up like him? What do you think?
I have two opinions on Grant Cardone. I actually love Grant Cardone. I really like, he was actually, when I was in college, I love watching his videos. It gave me a spark to get in entrepreneurship. I just liked his mindset and hustle, and he's got a great story coming out of rehab and all this stuff, right? Like I just respect that a lot. And now, do I love the way he runs his fund? No, not at all. And that's just from one person to another. Now, kudos to him for doing it. I've actually opted, I just cause I, do fun stuff. I opt into everybody's fund. So I've gone through Cardone Capital's, all their white paper, everything. I've gone on calls with all their guys. I wasn't going to invest, but I just wanted to see how they did everything. And, very expensive offering. They charge anywhere from 3 to 4% management fees, and they'll take a 30 to 45% split on gains, which is just uber expensive, right? And most people just don't know. They just don't know the difference. They just go, I like Grant, I'll put some money with him. So yeah, is it a Ponzi scheme? Is it a scam artist? I don't know. I don't want to say anything on this show, but if I was a betting man, if this economy hiccups, I think Cardone Capital is the first thing to go. Now I love Grant as well, but that's what I think. I don't know about you guys, but that's what I think.
Well, I'll fill in the blanks. So they just paid, I think, 40% more on a Florida multifamily than someone who bought it like a year ago.
Wow.
It was like 3 months before or something.
3 months before, right? So they haven't done there's no value add yet, and they paid 40% more than the previous buyer. Nice. And to me, a 3 and 4% management or acquisition cost doesn't line up very well with that. So
it just doesn't line up with your investors' incentives, right? And to that point, they're buying A core, they're buying, which when your economy hiccups, guess what? All the people in A and core, guess what they move to? They move to B class. And guess where B's move? B's move to C, right? I'm a big believer in B class apartments just because it's right in the middle there. Yeah. Anyways, that's crazy. 40% over asking for, or over last year's purchase price.
I think Plum was right. I think it was last quarter.
Yeah, last
90 days ago. Basically someone double closed.
Who was on the other side of that deal, bro? We got to get that guy on the podcast.
Yeah, right. He's the real genius.
$400 million complex. Unbelievable.
Golly, that's insane.
Yeah,
wow,
for sure. Hey, Bridger, if we would have talked to you a year ago, how have you changed? What have you changed your mind about in the last year?
It's a good question. In the last year, we've hired a bunch of people, and we've, grown up, I think a lot. And I actually am trying to transition from an entrepreneur of and that definition is very broad. My definition meaning someone who starts businesses and just likes to just build stuff and just get stuff going. Right. We've done that. I'm trying to transition from that person to now a CEO, and to transition to someone who can manage teams and build systems. All CEOs do is just manage systems. And so if I can become a better system builder of processes, funnels, properties, whatever it is, a team of people, that's the system. That's something I've been actively working on. That's the content I consume at this stage of the game is, okay, how do we go beyond the, not anyone, but a lot of, the first tier is you're under 10 employees, you can kind of manage that with one team. How do we go to 20, 30, 50 employees, have that second layer of leadership? And anyways, that's kind of what I'm getting into right now. But the biggest thing is that, and I have a great mentor I follow, and he just always harps on CEOs are system builders. You shouldn't be in the day-to-day operations. You should be building a system that automates the day-to-day operations. You got to be obsessed with building systems. So that's what I'm trying to get up. We've done a decent amount of it in our businesses, but we've already trying to get better of just building a bigger and better system machine that spits out cash. So that's where I'm coming from, if that makes any sense.
No, that makes a lot of sense. I think the EOS and traction stuff will tell you, hey, that's why you have a visionary and an integrator, right? Like two different people wearing those hats. I was going to ask, you have 3 partners. One does real estate, one does fundraising, and then you have you who does, it seems like everything else, right? So who's the visionary in your business? Is it you, or is like, how do you break up like the general business roles?
It's actually funny. So I'll just be super transparent with you guys. So, it's funny though. In investment fund secrets, that's our online marketing stuff. We have courses and stuff. So I have a different partner there. We're 50-50 partners named Mason Brains. Awesome dude. In that business, I feel like I'm more of the visionary and the like crazy, let's go do something wild online or just whatever. And I'm the face of it. And Mason's behind the scenes and he makes sure it all works, right? He runs the whole thing. Okay. And then in our fund, so that's different. In our fund, I've got 2 other partners. I am the operations guy in that. And I'm great in that role. I don't know. I like that role a lot. And actually, our other partner, I would say Dan is probably our visionary, crazy, go do crazy stuff guy. And Mike's execution on the real estate side, but I'm the execution on the legal, accounting, audit, compliance, all that stuff that takes a lot of work. I'm that guy. And so I know I keep hearing from people like, are you a visionary? Are you an executor? I'm like, I don't know. I feel like just depending on the circumstance, I've tried to mold myself to each one. I would say though, I probably tend to lean more to an execution operations person just because I tried to be the visionary in college. When I was, so back to my story, I started 6 businesses, right? Those first years of college. That's a lot of visionary, right? That's a lot of shiny objects. Oh, I'm going to do wholesaling now. I'm going to build websites. I'm going to go trade Forex. And I would start them and the first and those were actually businesses that got up and running. There was probably 10 other just ideas. And the visionary, I got this great vision. And I finally just learned by experience, nothing happens from a visionary. Visionaries are broke unless they have a good partner. And I'm like, well, do I really want to depend on a partner? No, I'm going to become an executioner. I'm going to become the person who can make crap happen. And so I finally was like, screw everybody. I'm just going to go learn wholesaling. I'm going to do it. Like we're doing wholesaling or we're doing website building. Like I'll read a book, whatever I need to do. I'm going to build some websites and we're going to charge people $5,000 a website. And so I think it just by the nature of learning that you don't get squat done with just being a startup visionary. Anyways, that's where I came. If that makes any sense, that's kind of the road I came on.
Yeah. Well, it takes time to figure something like that out. Like you ask a 19-year-old, are you a visionary or an integrator? 90% of them are going to say, I have no idea what you're talking about. And the other 10% is going to be like, I'm a visionary. Yeah, no one is mature enough when they're young to say they're the executor. But there's a test for that. And like we've taken it. I thought it was actually pretty accurate. So you should check it out.
Do you like doing, I've heard like people say, maybe you guys sound like you might've done it, but like when you have a new business partnership, you should all take personality tests to see if you fit. Have you guys done that and seen if you guys fit together and work together, or what's the deal?
Well, the funny thing is I think we had opinions like what our strengths and weaknesses are. And we were doing business for probably 8 months before we took any type of test. And then the results said like, I'm actually was exactly 50-50, like on the dot, like equal numbers, visionary integrator. And he was a little bit heavier visionary, less integrator. But honestly, like we make it work. Like, I don't know. It's not like I don't want to be absolutist. Like I think you can make a relationship work if you're flexible, but on paper, it says, I guess we wouldn't work, but I think we're making it work.
I got a master's degree in psychology, and I still think all those personality tests suck. I don't like any of them. I think a good partnership is just lots and lots of communication. Like talk about all the good stuff, talk about all the bad stuff, talk about everything. And that's what a partnership is, like being able to speak your mind, in my opinion.
That's interesting you say that because I'm not a believer in them either. Like a personality test, I just have a hard time because I feel, well, and I love your master's in psychology. Maybe you can give me a little psychological exam, but I feel like I am a different person when I'm around different people. I will try to transform to the people I'm around. So if I'm with my in-laws, I'm a totally different person than when I'm on a podcast with you, or when I'm speaking on a stage, or when I'm having a business meeting. I like really my personality, literally changes on how I work with those people. So anyways, when I take a personality test, I'm always like, well, which persona, the one that's with my in-laws the one that's at the business meeting or the one that's on stage speaking at a crowd? Like, which persona should I take this test as? And maybe I'm just, I don't know, maybe I'm a dual, whatever, like bipolar or whatever it is. Yeah, I don't know, but I feel like that's not uncommon. I don't know, maybe it is, but what are your thoughts?
No, I would just chalk that up as you have probably super high awareness. You probably have super high emotional intelligence. You're obviously a very talented guy, so you could probably do it all. So then I think you need
that was
to
a nice compliment to someone on your show to say that they're bipolar, but thank you.
No, then you just
No,
pick
just
which one you enjoy more, you know.
Yeah.
And or you do both. I don't think it really matters if you can make it work.
I think it's also the benefit of being young, right? Like your ego is probably less in the way than a 40-year-old who has, well, maybe less money than you, but they're just 40, right? Like I think as men get older in particular, their egos get bigger and they become less flexible with how they behave around people, right? It kind of becomes like a 45-year-old guy at the country club that kind of just sits at the bar and is like real quiet and doesn't put a lot of effort into conversation. Like a lot of 40-year-olds become that guy, you know, and you're still young, hungry, and you're going to flex to close the deal, right? Like you're going to flex your personality to close the sale. That's good. Like I wouldn't fret it.
That's a good point. I think, yeah. I think that's a good point of being able to, the 40-year-old, your ego hopefully gets in the way. And hopefully I don't know. Anyways,
yeah, no, don't worry about it.
I'm all getting in the way of that. But anyways, pretty interesting though on the personality test. I know I just keep taking them and I always get different results. And I don't know. So it's good to hear that you think it's total garbage. I actually like that, John.
One of my go-tos is just like, hey, you're an A player. Like, I don't care what test you take. You're an A player. I'm an A player. Frank's an A player. That's all the test needs to tell us. Let's move on, you know?
Yeah.
But hey, who do you look up to in this space? Where do you go for information? I came across your YouTube channel because there's so few people putting out high level content and engaging content like you. But besides you, and we'll give you a chance to plug all your stuff in just a second, but where else can people go to learn? Where are you going to learn some of this stuff?
Yeah, it's a good question. Well, I go right to my dad. and that's not helpful on this, but I literally, like last night, we sat down for an hour and talked about taking companies public, how that whole process works, small filings, filing SEC, all the stuff that goes into that. And I ask him questions 4 days a week. I ask him about, and he's kind of retired now. He actually just retired like 2 months ago. And so he's got time now. And he's just seriously the best mentor. I love my dad. I just can't give him enough praise. Beyond that though, great people that I like to go out and look for. Ray Dalio, so co-founder of Bridgewater Associates, founder of Bridgewater Associates. He's started to put out a lot of content recently. He manages like $450 billion. He's a good guy to listen to, right? He's incredible. I mean, a lot of these big hedge fund managers are starting to be more online a little bit. I know sometimes you have like the Bill Ackmans of the world that come on and tank the market overnight. That was by the way, that was the most incredible move last year on CNBC. He goes on, says all hell is about to break loose right as COVID was kind of getting there. And the next morning, I mean, markets were down like crazy. That whole thing happened. And little did everyone know he had like a $22 million dollar short position on the market, turned that into, what was it, like 2.5 billion or something over that. It was just insane.
Yeah, he had a great year for him personally.
He did well. So yeah, take it with a grain of salt. But I love Ray Dalio. Seems like he doesn't have a huge agenda behind him. I actually like listening to Kathy Wood a lot. Kevin O'Leary. Any big fund manager that will get on a show and talk, I like to listen and just hear their outlook on things. So those are a few people I look at and really look up to in the space. They're fun to watch.
Awesome. My peg is Ray Dalio is going to run for president someday. He came to West Point where Frank and I went to school and spent some time here. I was like, I think that guy's going to run for president someday. We'll see. But
I could see him trying to tee up a campaign. Steven Schwartzman's another one, co-founder of Blackstone. I mean, his book, Whatever It Takes, I love that book. And I wish he would do more content as well. Anyways, a lot of these guys are just too whatever to get on a show or podcast. We'll get them on. I'm trying to get these people on my show. Anyways, if you guys have connections to Ray Dalio, you let me know. Okay.
Awesome. All right. Bridger, how can people get in contact with you? How can they check out your YouTube stuff? How can they learn more from you, man?
Yeah. Our stuff on YouTube is just my name, Bridger Pennington. And go check it out. BridgerPennington.com. You can see all of our stuff there. And our brand stuff is all investment fund secrets. So investment fund secrets. If you search that, investmentfundsecrets.com, we have a 1 hour training. We have Facebook groups and we have PDF guides, and then we have coaching and whatever, anything, whatever you want. But the YouTube channel is a great place to go, or our podcast as well. So Investment Fund Secrets and Bridger Pennington, you should be able to find our stuff pretty easily. So
awesome. Well, really appreciate your time. This is one of those podcasts that I think I was a little nervous for, right? Because I think Frank and I are being vulnerable here, going like, hey, I think we're getting ready to start some fun stuff, but there's a lot of questions that we don't know. And so it was a little scary, but I think it was fun. Hopefully people got a lot out of it, and I enjoyed it.
Well, that's the thing about fun. Sorry, I know you're trying to close up, but
all good.
Most people, it's kind of just this world of, I don't know, right? Of just like, I don't know what's out, like what SEC compliance is and how to file. I just don't want to do something. I don't want to go to jail. And so most people never take the chance. And the example I use is like American football. If you'd never heard of American football, walked in a stadium, you'd just be utterly confused. Like, what is a fourth down? What's a punt? Like, what's offsides? Like, what is this game? This thing's ridiculous. I'm just going to leave. But if someone sat next to you throughout, the game and taught you the rules of football and how it's played and how it's worked, by the end of the game, you might enjoy it, and you might be able to understand some strategy, and maybe you could even, start strategizing on the game and know what they should have done or what shouldn't they have done. And the thing is the same thing with funds is most people just they're on the outside looking in like, oh, this game looks so crazy. But once you understand the rules, we're trying to teach people all the rules, how it works, how the game is played. And then you can come in and play with those rules and make strategies and go through it and have, follow one of the most lucrative business models of all time is running funds. So there you
awesome.
go.
Really, really appreciate your time. Frank, you want to take us out?
Hey, well, thank you, Bridger. I appreciate you coming on the podcast. I guess I'm in charge of outros now, so you caught me off guard, but I had a lot of fun. I appreciate you coming on, and thanks again.
All right, take care.